Brad Williams, Frugal Finance, Understanding Collateralized Mortgage Obligations, also known as CMOs. A collateralized mortgage obligation is a financial product that pools home mortgages and sells them as investment securities. CMOs are structured into different tranches or layers categorized by varying levels of risk and maturity. Investors receive payments based on the cash flow from the underlying mortgage repayments, making CMOs a complex but potentially lucrative fixed income investment. How CMOs work? Mortgage lenders issue home loans, which are then bundled together to create mortgage-backed securities. CMOs are a specific type of mortgage-backed security that divides these loans into segments with different risk levels. Investors purchase these securities and receive periodic payments derived from the mortgage principal and interest paid by homeowners. The structure ensures that lower risk tranches receive payment first, while higher risk tranches offer potentially greater returns but carry a higher chance of default. CMOs versus collateralized debt obligations. Both CMOs and CDOs are forms of structured finance investments. The key difference is that CMOs contain only mortgages, while CDOs can include various types of debt, such as auto loans, credit card debt, and corporate bonds. Both types of securities surged in popularity leading up to the 2008 financial crisis, with CDOs reaching a market value of $1.3 trillion in 2007, only to collapse in the aftermath. CMOs in the 2008 financial crisis. During the early 2000s, CMOs gained popularity as seemingly reliable income stream. However, the quality of underlying mortgages deteriorated, with many loans being issued to borrowers without income verification or with adjustable rates that became unfavorable over time. As homeowners defaulted, the value of CMOs plummeted, contributing to the financial crisis. In response, regulatory bodies like the Securities Exchange Commission and FINRA introduced stricter oversight in 2016, implementing margin requirements to reduce systematic risk in mortgage-backed securities. Risk and reward of CMOs, potential benefits, predictable cash flows. Investors receive regular payments based on mortgage repayments. Variety of risk levels. Tranches allow investors to choose different risk-reward options. Attractive yields. CMOs often offer higher returns than traditional bonds. Key risks: interest rate sensitivity. Rising interest rates can lower mortgage refinancing activity, impacting returns. Credit risk: if a homeowner defaults on their loan, investors in riskier tranches may suffer losses. Market liquidity: CMOs can be complex, making them harder to trade compared to traditional bonds. CMOs remain a significant part of the fixed income market, providing investment opportunities tied to the housing sector. While they offer structured returns, investors must carefully assess interest rate trends, housing market stability, and economic risk before investing. The lessons from the 2008 crisis highlight the importance of due diligence when evaluating mortgage-backed securities. If you have any questions or concerns regarding CMOs or CDOs or structured finance, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.